When you sit down to make a financial investment, you probably believe that you are making a completely independent and deeply rational decision. You look at the numbers, analyze the stock charts, and convince yourself that your logic is immune to the noise of the outside world. Classical economic theory assumes that human beings are perfectly rational actors, constantly calculating probabilities and risks to maximize their personal profit in every situation. However, behavioral psychology paints a vastly different picture of the human mind. The truth is, your brain is not fundamentally a calculating machine. Instead, it is a highly evolved social survival engine, wired over millions of years to prioritize the safety of the collective herd. This brings us to one of the most dangerous psychological traps in the modern financial market: the pervasive and silent power of herd mentality. Herd mentality occurs when investors blindly follow the actions of a larger group, completely abandoning their own individual analysis and independent critical thinking. When you see an asset price skyrocketing, a deep biological trigger is activated. The rising green line becomes a signal of absolute safety. Your brain interprets the crowd's buying behavior as a form of verified intelligence. If everyone else is doing it, they must know something you do not. This cognitive shortcut is known as social proof. In a complex and unpredictable market environment, the brain desperately seeks cognitive ease and validation. It takes significantly more mental energy to stand alone against the current than it does to simply surrender and flow with the massive tide. As a result, you abandon your carefully planned investment strategy. You start buying assets at premium prices simply because the crowd is cheering. The illusion of individual choice vanishes entirely. You are no longer an active investor. You have become a passive passenger driven by collective euphoria. But the fundamental problem with following the herd is that the crowd is almost always wrong at the most critical turning points of the market. When the inevitable crash happens, the same herd mentality that drove the manic buying will rapidly transform into a devastating stampede of panic selling. To truly understand why the modern investor behaves so irrationally, we must look backward. We must examine the evolutionary history of the human brain. Hundreds of thousands of years ago, our ancestors did not have the luxury of independent critical thinking when faced with immediate physical danger. Imagine a primitive human foraging on the savannah. Suddenly, the rest of the tribe starts running frantically in the opposite direction. In that critical moment, the individual who stops to analyze the data, looking for the hidden predator, is the one who gets eaten. The individual who simply copies the panic of the crowd and runs without questioning survives to pass on their genetic material to us. This survival mechanism, deeply embedded in our amygdala, equates the actions of the majority with absolute safety and biological survival. Fast forward to the 21st century. We no longer run from prehistoric predators, but the ancient hardware of our brain remains exactly the same. Today, the savannah has been replaced by the volatile financial markets, and the physical predators have been replaced by the fear of financial ruin. When a stock or asset class begins a massive, unprecedented upward trajectory, the financial media amplifies the frenzy across all channels. Your brain perceives this mass movement not as a speculative bubble, but as a moving tribe that you must urgently join to survive. The neurochemical reward for conformity is a massive release of dopamine, making you feel secure, smart, and validated just by being part of the group. Conversely, stepping away from the herd triggers the pain centers in your brain. Social isolation historically meant certain death, and your mind remembers that. This is exactly why being a contrarian investor is psychologically exhausting. It requires you to actively fight against millions of years of evolutionary programming. Your logical prefrontal cortex tries to read the fundamental data, but your primitive amygdala screams at you to just follow the glowing green trend. Understanding this biological mismatch is the first crucial step toward protecting your portfolio from the destructive forces of the herd mentality. Every financial bubble in human history, from the Dutch tulip mania to modern speculative assets, follows a precise psychological structure known as the anatomy of a bubble. It always begins with the stealth phase. In this initial stage, prices are low, and only a small group of highly informed investors recognize the underlying fundamental value. During this early period, the average person is completely unaware. They sit at their desks, focusing on their daily routines, oblivious to the financial shifts happening around them. Then comes the awareness phase. Institutional money starts flowing in. The chart begins to show a steady, undeniable upward trend, catching the attention of early institutional adopters. This is when the narrative starts to form. A compelling story about a new paradigm or revolutionary technology is created, triggering the first wave of widespread public interest. Suddenly, you start seeing headlines everywhere. The news feeds on your monitor begin flashing green, and the constant exposure begins to plant the seeds of curiosity. The brain's reticular activating system is now primed. It starts filtering information, forcing you to notice every single success story and every massive profit made by others. This marks the transition into the mania phase. The general public rushes into the market. The price chart no longer reflects reality. It reflects pure, unadulterated collective emotion. The green line shoots upward at an almost vertical angle. The financial asset becomes a cultural phenomenon, dominating every conversation at dinner tables and corporate water coolers. You watch your peers getting wealthy effortlessly. The psychological pressure becomes unbearable. Your logical defenses are finally breached by the overwhelming power of social proof and peer validation. Fear of missing out takes complete control. The herd is moving at breakneck speed, and the biological urge to join the safety of the crowd overrides all caution. At this critical juncture, traditional valuation metrics are thrown out the window. Experts who warn of a crash are ridiculed as being outdated or simply not understanding the new era. You finally cave in. You transfer your hard-earned savings, convinced that this time is different, completely unaware that you are buying at the absolute peak of the cycle. The bubble has now reached maximum expansion. The market is saturated with euphoric buyers, and there is literally no one left to drive the price any higher. Fundamentals no longer matter. The entire structure is now solely supported by the dangerous illusion that there will always be a greater fool willing to buy at a higher price. Now that we have mapped the anatomy of a bubble, we must zoom in on the exact psychological catalyst that bridges the gap between rational awareness and pure mania. This catalyst is FOMO, the fear of missing out. It is not merely a modern internet buzzword, but a profound state of cognitive and biological emergency. When you experience FOMO, your nervous system reacts exactly as if you are facing a severe physical threat or experiencing genuine social ostracization. You are not just reacting to a rising price chart. You are reacting to the perceived sudden wealth and elevated social status of your immediate peers. Humans are deeply status-driven creatures. When a colleague effortlessly doubles their net worth, your brain fundamentally registers this as a drastic drop in your own relative status. In evolutionary terms, a drop in relative social status meant reduced access to crucial resources. Your brain perceives their financial gain as your direct survival loss. This triggers a bizarre mutation of loss aversion. You are no longer afraid of losing your actual money. You become terrified of losing a hypothetical future. You start mourning the phantom wealth you could have made if you had only invested earlier. This imaginary loss causes actual, severe psychological distress and anxiety. The psychological pain of standing on the sidelines while everyone else apparently gets rich becomes so acute that rationality completely collapses under the intense pressure. You finally surrender. You buy into the highly inflated asset, not because you understand its fundamental value, but simply to stop the psychological pain of missing out. The exact moment you execute the buy order, the anxiety vanishes. Your brain floods your system with dopamine, rewarding you for finally rejoining the safety of the herd. You feel a profound, yet entirely false, sense of security. You are now comfortably inside the bubble, surrounded by millions of others sharing the exact same delusion. You enter an echo chamber. You actively seek media that confirms your bias, aggressively ignoring any analytical voices that warn of an impending and inevitable market correction. This collective suspension of disbelief pushes the asset price to mathematically impossible heights. The market rapidly approaches a dangerous state of maximum psychological exuberance. Blinded by FOMO and comforted by the warmth of the crowd, the modern investor stands confidently at the very edge of the precipice, completely unprepared for reality. Welcome to peak exuberance, the final, most dangerous stage of any financial bubble, where logic is completely replaced by collective delirium. Asset prices detach entirely from any historical reality. Valuations are no longer measured in multiples of earnings, but in multiples of imagination. This environment breeds the Dunning-Kruger effect. Novice investors, seeing immediate returns in a market where everything is going up, suddenly mistake luck for genius. Everyone becomes a financial guru. Your taxi driver, your barber, your cousin, they all start offering unsolicited investment advice on assets they barely understand. People begin to despise their regular jobs. Why work for a month when you can make the same amount in a day by pressing a button? To maximize these easy gains, investors introduce leverage. They borrow money to buy more assets, stretching the elastic band of risk to its absolute limit. Rationality is gone. You tap into your emergency savings, take out loans, or even leverage your house, confident that the market will only go up. Any dissenting voice is aggressively silenced by the herd. The echo chamber validates every reckless decision, reinforcing the delusion of invincibility. But a bubble requires a constant influx of new money to sustain its growth. Eventually, everyone who could possibly buy has already bought. The liquidity dries up. The pool of greater fools is completely exhausted. The market is now a towering, unbalanced structure built entirely on leverage and hope. At the very top, the exuberance begins to waver. A tiny piece of bad news, or simply the weight of gravity, starts to test the fragile foundation. The smart money, the institutional investors who bought during the stealth phase, begin to quietly exit. They sell their holdings to the euphoric retail crowd. As the price dips, the herd enters the phase of denial. They convince themselves it is just a temporary dip, a healthy correction before the next massive leg up. But gravity cannot be ignored forever. The elastic band of leverage is stretched too far. The illusion of the greater fool is about to shatter completely. And then, in an instant, the paradigm shifts. The peak exuberance dissolves, and the tipping point arrives. The tipping point is rarely a single, catastrophic event. It is usually a subtle shift in psychology, a sudden realization that the emperor has no clothes. The constant stream of new buyers slows down. The initial selling pressure from institutional investors starts to outweigh the fading buying power of the retail crowd. At first, there is disbelief. The retail investor, looking at their screen, assumes this is just a temporary dip, a buying opportunity, just as they have been conditioned to believe. The echo chamber goes into overdrive. Forums and chat groups are filled with frantic messages urging everyone to hold the line, to stay strong against the invisible enemy. But hope is not a fundamental metric. When the leverage positions start getting liquidated, the selling pressure becomes a mechanical force, entirely devoid of emotion. Then, the first major support level breaks. The psychological dam collapses. Suddenly, the narrative flips from getting rich quick to survival. The price chart becomes a waterfall. The same biological circuits that pushed the crowd into the bubble now reverse polarity, triggering pure, unadulterated fear. The herd mentality does not disappear, it simply changes direction. Everyone rushes for the exit at exactly the same time, trying to escape a burning building through a single, narrow door. You sit frozen. The logic centers of your brain are completely overwhelmed by cortisol and adrenaline. The psychological pain of the loss is excruciating. Behavioral economics proves that the pain of losing a specific amount of money is felt twice as intensely as the joy of gaining that exact same amount. This is loss aversion. To avoid making this psychological pain permanent, you refuse to sell. You hold on to the depreciating asset, trapped by the sunk cost fallacy, hoping for a miraculous recovery. But the market doesn't care about your hope. As prices fall further, leveraged accounts are forcibly liquidated, triggering a cascade of forced selling that accelerates the crash. Finally, the capitulation phase arrives. The pain becomes too much to bear. Investors sell their assets at absolute bottom prices just to make the suffering stop. The wealth transfer is complete. The herd has bought at the top out of greed and sold at the bottom out of fear, completely devastating their financial standing. To survive this brutal cycle, you cannot simply try to be smarter than the market. You must fundamentally rewire the way your brain processes financial information. To truly understand the severity of a market crash, we must analyze the biological mechanics of panic. It is not a rational exit. It is a primal stampede. Panic is highly contagious. When the herd senses an immediate threat, the amygdala hijacks the brain's processing center, overriding any logical long-term strategy. Your screens, once filled with stories of endless wealth, are now completely overwhelmed by headlines of absolute disaster, further feeding the biological fear response. This panic triggers a mechanical chain reaction. Stop-loss orders execute automatically. Margin calls force brokers to liquidate assets without human intervention. You desperately try to exit the market, but the door is too small. When everyone wants to sell and no one wants to buy, the price simply gaps down to find liquidity. The asset hasn't necessarily changed its fundamental nature, but its perceived psychological value has evaporated completely. The illusion of safety is gone. As the dust settles at the bottom of the crash, the herd is left emotionally battered and financially depleted. The dopamine rush is replaced by a profound neurochemical crash. In isolation, the logical brain begins to slowly turn back on. You look at the destruction, and the feeling of loss is compounded by an intense, burning sense of shame. Ironically, it is exactly at this point of maximum despair, when the asset is fundamentally undervalued, that the traumatized brain completely refuses to buy. The amygdala has created a negative conditioning loop. The mere thought of re-entering the market now triggers a physical panic response. You are permanently sidelined. This is the ultimate trap of the herd mentality. It perfectly engineers a scenario where you buy when the risk is highest and sell when the opportunity is greatest. So, you return to your desk. You resume your normal work routine, financially poorer, psychologically exhausted, and swearing to never touch another investment again. But running away is not the solution. The financial markets will continue to operate, and inflation will quietly erode your purchasing power if you simply hide. To rebuild, you must shift your perspective. You must stop looking at what the massive crowd is doing and start looking deeply at your own logical process. This requires mastering the art of letting go. We must now dissect another severe cognitive trap that keeps investors bleeding money: the devastating sunk cost fallacy. After the crash, a new psychological demon emerges from the rubble. It is the insidious trap known in behavioral economics as the sunk cost fallacy. Imagine you have heavily invested your hard-earned capital into an asset that has now plummeted. You are sitting on a massive, painful loss. Logic dictates that you should objectively evaluate the asset's current future potential, completely ignoring the money you have already lost. The past is gone, but human brains hate realizing a loss. Selling the asset forces you to accept the painful reality that your initial decision was undeniably wrong. So, instead of cutting your losses, you do the exact opposite. You double down. You throw more good money into a bad investment, desperately hoping to average down your cost. You are no longer investing based on the asset's fundamentals. You are merely trying to rescue your past self. You are financing your own psychological ego. This relentless spiral of trying to repair a broken trade completely drains your remaining capital. The refusal to accept a minor loss ultimately guarantees a catastrophic one. To our ancestors, abandoning a half-built shelter or a partially hunted animal meant wasting crucial energy. Persistence was highly rewarded in the physical world. But the financial market is an infinite landscape of new probabilities. Persistence in a fundamentally flawed trade is not endurance. It is just financial suicide. You must train your brain to embrace the immediate sting of realizing a loss. Accept the mistake, sever the heavy chain, and preserve your remaining capital for better opportunities. Only when you free yourself from the psychological anchor of your past mistakes can your prefrontal cortex regain control. You stop gambling, and you start analyzing again. Remember the golden rule of behavioral finance. Never fall in love with your investments. They are simply tools to transport value, not reflections of your personal self-worth. Rewiring your investor brain requires a deliberate effort to shift from primal emotional reactions to structured, logical processing. You must build a psychological firewall. The first critical step is isolation. You must aggressively cut off the constant stream of financial noise, social media hype, and unsolicited advice. By turning off the external stimuli, you actively lower the cortisol levels in your brain, allowing your prefrontal cortex to regain operational control. Next, you must establish a strict set of mechanical rules. These rules act as an algorithmic defense mechanism against your own unpredictable biological impulses. Write down your investment thesis. Before deploying any capital, explicitly define your entry points, your exit strategies, and your maximum risk tolerance on paper. This pre-planning forces your brain to engage in slow, analytical thinking, effectively bypassing the quick, emotional shortcuts that lead directly to the herd mentality. When the next inevitable wave of market euphoria arrives, your predetermined rules will act as an impenetrable fortress, protecting you from the contagious panic. You must also cultivate the psychological endurance to be a contrarian. True financial independence means being entirely comfortable standing completely alone in your convictions. This means deliberately ignoring the frantic validation of the crowd. You learn to trust your fundamental analysis over the loud, temporary cheers of others. Instead of staring obsessively at fluctuating price charts, you look under the hood. You analyze the intrinsic value, the cash flow, and the raw mechanics. When you understand the fundamental reality of an asset, a sudden drop in price no longer triggers primal fear. It simply presents a mathematical opportunity. However, rewiring is a continuous, daily practice. Your evolutionary hardware will constantly attempt to drag you back into the comfortable illusion of the herd. You must treat investing not as an adrenaline-fueled casino game, but as a disciplined, emotionless procedure requiring the absolute highest level of self-awareness. By mastering your own psychology, you completely remove the emotional leverage that the market holds over you. You stop reacting and you start acting. Ultimately, the greatest financial asset you will ever possess is not a stock or a piece of real estate. It is an independent, disciplined mind. In conclusion, the market is not fundamentally a place where wealth is created out of nothing. It is a psychological arena where wealth is transferred. It is transferred from the emotional, the impatient, and the biologically reactive directly into the hands of the disciplined, the analytical, and the patient. You can choose to remain a slave to your evolutionary programming, reacting to every flashing red and green light on your screen with fear and greed. Or you can choose to step back, build your psychological firewall, and approach the market as an active thinker rather than a passive follower. The market is essentially a mirror. It reflects your deepest insecurities and your greatest flaws. Master yourself first, and the charts will finally make sense. Thank you for watching. Remember, true wealth is not just about accumulating capital. It is about cultivating the psychological discipline to keep it. As a final reminder, the concepts discussed in this video are for educational and informational purposes only. This is not professional financial advice. Always conduct your own thorough research, understand your personal risk tolerance, and consult with a certified financial advisor before making any investment decisions.